Hello and welcome to the Anew Advisors webinar education series. Thank you for joining us today. My name is Liz Notling and I'm the Director of Operations for Anew Advisors. Today, our webinar will be focused on the economic review or quarterly market update for the fourth quarter of 2023. Glenn Colwell and Nick Steiner will be presenting, but just a few housekeeping things before we get started. Today's webinar is recorded, so you will be able to rewatch this or share it with other individuals that you are interested in. During the presentation, you may ask questions. There is a question bubble on the bottom of your screen where you'll be able to type questions, but at the end, we will also be doing a Q&A as well. So without further ado, I'll go ahead and welcome Nick and Glenn.
Thank you, Liz. I appreciate that. We will go through our quarterly market review here. We'll touch base a little bit on the fourth quarter and year end of 2023 and just share some of our thoughts with you. Like Liz mentioned, you can feel free to put questions in the chat box. You can also contact us after the fact. Sometimes we get some emails or some phone calls of questions that you might have thought after the fact. So we do appreciate your attendance. And then this is the agenda. We'll kind of just move through pretty quickly here. We never aim to make this a long thing. This should just be an update and just some highlights. So let's move on to the next slide, Liz. Our mission, vision, values, we always start with this. It's also on our website. We're very, very proud of this. And our team tests each other all the time and we hold ourselves accountable. We will do everything with transparency and integrity. So that is our mission. As we deal with our clients across the country, both in public sector and private sector. This is our team. I don't know, I thought we discussed we were going to get new pictures, but maybe one of these days we actually do, instead of look like the Brady Bunch. So from left, myself, then Michael Bongiorno, Director of Fire Services and Business Development, Anthony Zilli, Director of Client Acquisition. Below Anthony is our lovely Liz Notling, who you heard earlier, Director of Operations, and then Sean Laudar, Director of Law Enforcement Business Development, and Nick, who will be speaking and taking part of this presentation, our Director of Investment Strategy. History, I think we're going to get to update this this year, but this has just been an unbelievable combination of experience in many different facets, both private sector, public sector, facing clients of all different types, corporate, nonprofits, individuals, families, endowments, foundations, etc. We're very proud of our financial industry experience, and it's led to us being 100% transparent and with integrity. That's in our mission. This is our education calendar for 2024. So we updated this at the end of 2023. For our 2024 topics, it's monthly. So as you see at quarter end, right, January, April, July, October will always be the quarter end of the previous quarter. We'll give the market update, but we have some pretty interesting topics this year. Hopefully you tune into those, and we do record all these as well. All right, let's dig in here. The topic du jour, like what are the most recent monsters that you hear in the headlines? I always say this, the news, whether you consume that via radio or TV or newsletters or blogs or social media, however you consume the most recent news, it's always Armageddon. And so we have a lot this quarter. We've made some updates. Now we can add the war in Gaza on top of Ukraine, as well as funding several different wars. High interest rates, we're probably at the height of the interest rate cycle. If you read our December 2nd or 5th email that we sent out to clients, we have made some portfolio changes due to interest rate movement going forward. We do think it's probably the next move is down, but we will discuss that a little bit later as in the rate decreases. Cost of living is still elevated in some areas, but not all. You're seeing inflation drastically reduce, but you're going to still see some elevated cost of living, particularly groceries, right? I mean, I don't know anyone that doesn't go to the grocery store and complain now. So that is an issue, and that is hitting everyone in their pocketbook and at home. And then lo and behold, we're finally here. We're in the presidential election year. So strap in your seatbelts, get ready for some lovely fighting as they've been doing for years, but I think it's only going to intensify, unfortunately. But be wary of listening to the news on this. This is going to get ugly, and it's probably going to cause quite a bit of volatility in the second half of 2024 for the markets and the economy. But it is what it is. It's here, and I'm actually thankful it's here, and I'll be happy on November 6th when it's all done. So next slide, please. You hear us talk about this a lot. This is the cornerstone of our investment philosophy. It's about consumption demand. You can't sell anything unless you have somebody to buy it. And that's the whole premise of capital markets and the economy. If you produce a good and service and you can't sell it, it's useless. But you have to go where consumers are. And where consumers are in the United States of America. And they're there by the largest population in the world, baby boomers and millennials. You glue them together. You hear me say this all the time. They are the most consumption demand curve sitting in front of you in the world. You can't go to any other country and glue together that number of people sitting in front of you. So that's why we predominantly invest in the US, along with some other economic factors, but get in front of demand consumption and buy the companies that produce the goods and services. Our returns. So we break out our portfolios into kind of several different themes, if you will. All of them have the same investment philosophy, though. We just try to touch a little bit different parts of the market. So we'll show you a little bit about December end and then year to date. I'm going to touch on this very, very high level. We get in depth in this in our client annual reviews, of course. So we run an income portfolio, 100% income. It's stocks that produce dividends. We've made some changes, a little bit of that as December 2nd. We're starting to add back bonds. If you have heard us for years, the last 3 to 5 years, you didn't want to be in bonds in a rising interest rate environment, and you didn't. And you see that if you let your eyes filter down a little bit, you'll see that you have two indexes, the Vanguard Total Bond Return, which measures the total bond market. If you look at year to date, it's up 2.38%. But honestly, it took December's return to make that positive. If you look at the BND 5-year, that's the 5-year return of the total bond market. You're negative almost 8%. This is why we didn't allocate anything to bonds. And the reason we decided to move back into them in December in a small fashion, anywhere from 20 to 30%, is because you're probably at the end of the interest rate increases by the Fed. If the next move is down, you will greatly benefit from existing bonds, right? You'll clip the coupon at whatever percentage is paying 4, 5, 6% in interest, and you'll most likely see a capital appreciation out of that bond over the next 6 to 18 months because the next bond issue will have a lower interest rate. Any questions on that, please feel free to call us. So we run an income portfolio. We run a 70-30, that's 70% income, 30% tech. We believe in tech, and all you have to do is let your eyes float down to indexes and funds and go to the triple Q. That is an ETF or an exchange traded fund that's widely used in the market that measures the returns of technology companies. That was up 5% in December and 53.79% for the year of 2023. Not without volatility. If you would just look at that, you would say, oh my God, that's been an unbelievable ride. I should have been in that all of 2023 and it would have been up. There were times where that was negative at the beginning of the year. It's a very volatile sector, but a very rewarding sector as our economy will rely more and more upon technology. Our straight tech portfolio on top returned 8.41 in December and 36.04 year to date. We have what we call long-term growth, where we really place emphasis on just growing the portfolio for clients that have maybe lesser dollars or our associations. And that portfolio has done very, very well. And then we build a benchmark. A lot of investment managers will say, let's use the S&P 500 or the Dow or the Russell 3000 as a benchmark. We don't think that's a fair representation. So we really hold ourselves accountable with this custom benchmark. It has some large US stocks, some mid-US stocks, some small US stocks, and some real estate. And that's what makes up a bulk of our portfolios, predominantly US and predominantly paying some type of cash flow in the form of dividend or interest. And then we measure it against just kind of other blends, if you will, but we can get more of that in your annual review. Next slide. Our investment philosophy, I already mentioned on the far right, the demographics. We prefer individual securities versus mutual funds. We don't want the embedded fee in mutual funds if we can avoid it. And then we put a large emphasis on dividend paying or cash flow of our securities. We want cash flow being rewarded to our shareholders. And I'm going to turn this over to Nick. He'll start touching on kind of the market aspect of this call.
Yeah, thank you, Glenn. And so this is what we're looking at here across the different sectors. And so how the year kind of finished up, you see we're going to go down to this line where it says Q4 or 4Q 2023. The only things that were really down there in that fourth quarter were if you held energy. And even over the year, the only sectors that were down were going to be our energy and utilities. And a lot of this is due to higher interest rates. Those are a lot of your big dividend payers. And what happens is these interest rates get higher and you can earn more cash on things like money markets, CDs. We do tend to see these things suffer because the cash flow that you normally get from the energy sector and utilities is hurt by that. And then I'm also going to have you focus on consumer discretionary and tech in the middle there. You can see that people are still spending, and a big portion of that is still driven by technology, which we're going to get into here. Next slide, Liz. This is one of my favorite charts that we show every review or every quarterly update that we do, and it shows the intra-year declines. And what this means is that at any given point in the year, the market is more than likely going to be down compared to where it finishes. So if we look all the way on the right to 2023, at one point in the year, if you were holding the S&P 500, you were down 10%. But where did we finish on the year? Up 24%. And this is why it requires patience. And as we go through the years, we're going to see a lot of volatility and a lot of choppiness in the market. But despite that, 33 of the last 44 years, the market has still ended positive. Next slide. And this is showing some of the inflection points. This is going all the way back to 1996, but I'm going to have you focus again on the right-hand side, going back to the start of 2022. So 2022 was a volatile and down year. So you can see where the S&P 500, where we took that hit going down throughout the year, but then we've been crawling back. So by the end of the year, we've recovered most of the negative downturn that we've had from 2022. We recovered most of that by the end of 2023. But as you can see, it was not without some volatility. We had the drop in the middle of the year, but this is why it's important that we stay invested and continue to stay on the path and sticking to the investment philosophy. Because especially when you're holding some of these dividend payers that we believe in, you're reinvesting all the way down. And so that when the market comes back up at the bottom of these inflection points, you have been reinvesting, you have more shares to grow. Slide. Now, when we talk about the S&P 500, if you've had an annual review with us over the last couple of years, we've talked about this pretty heavily, where it has been super concentrated in a couple of very large holdings. And that is your Apple, Broadcom, Google, NVIDIA, Microsoft. Those top 10 companies are driving what this chart is showing, 86% of the S&P 500 return over the last year. So what that means is that it's very concentrated in those 10 holdings. And so if you're not holding those in excess compared to anything else in your portfolio, you're not going to see the same return as the S&P 500. And that's been a theme for about the last 2 years. And you can see the remaining stocks there only contribute the remaining 14%. So that's the other 490 companies on the S&P 500 only contributed that 14%. Next slide. So now we're going to jump into fund rates, the interest rates that we're expecting. Like Glenn mentioned earlier, we are sitting towards the top. That 5.38% is where we're at now. And then what you're seeing is what the market expects for the Fed funds rate, along with some other projections. And you can see over the next year, everyone is pretty much projecting that we're going to get some rate decreases. How much, we don't know. At the low end, our estimates, we can see about 1 to 1.5% drop, but there are some estimates out there that think it could drop a full 3%. I don't know if we'll get there quickly or if it'll be over the next couple of years, but we will see some drops over the next year. Next slide, Liz. Growth in GDP. What I want to focus on here is you see that trend line of 2% growth. That is typically what is targeted, trying to get that 2% growth. And we have been able to come back to that trend line over the last year. We had some big hits down in 2020 due to some supply chain issues, but we have trickled back up to where we would like to be in terms of GDP and economic growth. And then the other thing I always like to point out here is what drives it. And the biggest portion is consumption. And a lot of that is due to the demographics in this country, the baby boomers and millennials either being in their highest earning years, spending down their retirement, or the millennials, which are the largest generation, again, trained to spend. So GDP being driven by consumption will continue to be the driving force in what we see grow the economy. This is looking at, again, where we're seeing some opportunity here between growth and value. And growth stocks are, again, your big tech stocks have been driven up and they're getting a little bit expensive. So what we look at when we look at potential investment opportunities, like Glenn mentioned, we have thrown some in bonds because of what we see happening in interest rates. And we do still hold true on the value, which is typically more of your dividend paying securities. And so right now you're going to see that value is still relatively cheap compared to growth because we've had such a big run up in those tech markets that we looked at earlier, that more of the buying opportunity is in your value companies with some of these stronger balance sheets and income statements.
And if I could just mention one thing in that previous slide, like, because we hold value-based stocks, dividend-paying stocks, that places an emphasis on cash flow. If and when the Fed does move their interest rates lower, that bodes well for those companies, right? Because they're paying cash flow, and for those that need cash flow, they typically will find securities, whether it's bonds or stocks, that pay a higher interest rate, and that bodes well for dividend-paying stocks in a declining interest rate environment.
Yep, and on that chart, we kind of saw that play out as well. This is another one that I like because we measure things called consumer confidence and sentiment. And what this looks at is how people in general feel about the markets. And what this shows, and what I want you to focus on, is you see that section that says the 9 sentiment trials. What that means is the bottom point. When people feel the worst about what's going on in the markets, and what happens after we hit those low points. So there were times, as you can see in 2022 in June, where we were at a low point over about the last 30 years and how people really felt about the market. But as we got into 2023, you can see that the markets have returned and sentiment has come up. We're not quite back to the average yet in how people feel about the market, and we're expecting it to stay around this area for a little while because of what's happening in the election. What the markets don't like is uncertainty, and coming into any election, because you don't know the outcome, there is uncertainty. So we should see the sentiment, how people feel, come back after the election. But the important part to note is that the returns after these bottoms averages 24.1%. So when people feel the worst and you're feeling bad about what's happening, maybe in your 401k, your 457, that's the time to really buckle down, make sure you continue to add money in, because the biggest returns typically happen after those lowest points. And here again, a little bit on inflation. Again, you've heard me talk about in our reviews, headline numbers over the last 2 years have seen 10, 12, 13, 14%, depending on the indicator you look at. But we've held pretty firm that long term, it's going to be closer to that 4% mark. And you can see right now, that's where the headline and the core number is sitting at the 4% inflation mark. So this chart is showing over the last 20 years growth of the major sectors people talk about, right? This is including stocks, bonds, and then the traditional 60-40 portfolio. That's the modern portfolio theory one that people generally like to point to. And again, our big position in stocks over the years has been, strictly due to this, right? So we've seen larger returns out of holding stocks rather than holding bonds. And while we do see that we have added some bonds because of the position now, we've never been real big believers, and we've never held even up to that 40%. And this speaks to why.
Yeah, and I would just comment on this. I mean, that's the total returns from 1950 to 2023. That's 73 years, and to hold bonds at 5.5%, if you actually broke down that chart over time, there were many negative periods through that for holding bonds. And so it's not that we're anti-bonds, it's use the tool or the security at the point of the market cycle that makes the most sense. Bonds have always been saying like this safe asset. That's not true. And so we're trying to pick the right security type for the environment that we're in to produce the best cash flow for our clients.
Yep, perfect. And then this last one here, I want to go back and just talk a little bit about recessions and again, the subsequent bear runs or the bull runs that typically come after. So what they consider a recession, this is kind of a moving target sometimes, but the current target now is anything below 20% in the market returns. And it might be a little hard to see, but I want to point out that at the bottom, the last real recession we had was going back to the pandemic. And what you'll see is at the bottom, that line 13, back in February of 2020, the bottom was 34%. And this is what they consider the last recession. That and the subsequent bull run after. And so what you're going to see is that since that bottom, the market's returned a pretty significant amount. And it happens with any subsequent bull and bear run. So while the average is down for bear markets about 40%, the subsequent bull markets average 162% coming out. And so that again just speaks to, no matter how you feel about the market, when you're feeling the worst, when the market's doing poorly, there are recoveries, and over longer periods of time, the market has recovered. Next slide. That's it. That's the end of our quarterly market review. Does anyone have any questions for us, whether it's regarding the portfolios, the market, the economy, anything we can answer?
And I would just add this, thanks for attending everyone, but please take advantage of your annual reviews. And if you're wondering, how to strategically plan, whether you're an association or corporation or individual, we have tools to help you do that through these different market cycles. So please feel free to reach out to any of us or any of our business development officers. Thank you.
All right, no questions coming in. So again, thank you, everyone. If you would like to reach out, whether you are on the fire or police side, these are our two director of business development. For those, you can scan that QR code to get all their contact information, and their email is below, or you can always feel free to reach out to Glenn or me directly. So again, thank you, everybody, and we'll talk to you all soon.
This concludes our webinar for today. Thank you.